that initial move or the gift Nifty move only, flattered to deceive us. We've slipped into the red already, and that's the case with the Nifty Bank as well. Let's find out what the slightly longer term picture is, and who better than Prashant Jain to throw light on that, Chief Investment Officer at 3P Investment Managers. Prashant, hi, morning. Great to have you on ET now once again. Prashant, I was just going through your latest note, wherein you've titled it as "This Too Shall Pass." After 35 years in markets, Prashant, what is giving you conviction this time around that A, this will pass? Are there any parameters or monitorables that you're tracking closely? And B, whether this is not going to lead to some sort of structural damage for our markets?
Morning, Aisha, and good morning, everyone. It's a pleasure being on this show. I think this is not the first war that we are experiencing in the world. I mean, wars have been there, I don't know for how many thousands of years, and they eventually end. And of course, since India is not a party to this war, our impact is mainly through the oil prices, the gas prices, and any disruptions in the supply thereof. I'm not saying it will not impact India, but it will clearly, this impact will not, I think, be either material or be permanent. India is far better placed to handle the oil price shock this time around than in the past. India's imports of oil is quite low compared to the past levels, around 3% of GDP equivalent is oil imports. So it can have some impact on current account, even if oil averages at $110 or so. I mean, your current account can go from 1% to 2%. It is possible, but I think that is quite manageable. Similarly, on the fiscal side, I think our fiscal consolidation has taken place. There is some room to absorb some stress. Of course, individual sectors which are facing challenges of feedstock, etc., they may get impacted. But I think at least as far as the large caps are concerned, if you look at the Nifty composition, I think there are hardly any or very few directly impacted sectors. Their weightages are very low. And of course, if you build a case that this will go on for a fair bit of time and oil will spike up further, then yes, it can have a further impact on stocks, maybe on the economy. But I think these will also pass over the next few quarters. Yes.
But Prashant, you're making that case that India's oil vulnerability has reduced quite significantly. Despite all the challenges with the Strait of Hormuz, we're still seeing, a continued supply, delayed albeit. You were also pointing out in that note, very interestingly of yours, that when oil went from $25 all the way to $140, which was between 2000 and 2008, India still grew at 7%. But I just want to play devil's advocate here because, the macro picture looked very different that time. Rates were lower, global growth was strong, and FIIs were continual buyers. Those conditions, Prashant, don't exist today. What's convincing you still about the India story?
Aisha, I am not implying that if oil goes up, it will have no impact on GDP. I did not imply that. What I meant to say was that even when oil went up 5x, India still grew at a fairly decent pace. So it is representative of the resilience of India. And of course, this current environment is somewhat different from way back then. Capex was in a strong upswing way back then. Commodity prices were going up across the board, and foreigners were buyers. Yes, but I think there are few things which are even today quite mitigating of this effect. Look at the capital markets. The primary markets are sharply down, while the focus is entirely on FII selling. But primary markets also represented an equal, if not larger, source of supply. And with investors having lost money on 2 out of 3 issuances over last 18 months or so, the appetite for participating in similar issuances is clearly extremely weak. So I feel with primary markets unlikely to raise any meaningful capital, at least for some time. The domestic flows will largely get diverted or get invested in the secondary markets. And that should enable a decent absorption of any foreign selling that is coming. And over time, since locals are likely to continue to remain buyers, these flows, I think, are reasonably structural. I think whenever there is stability, whenever there is clarity, whenever foreign selling moderates or stops, I think these markets should actually do well over time. Yes.
Prashant, hi, morning. Given the fact that West Asia crisis continues and there will be some impact on macro front, how are you, building portfolio for your clients? Which are the sectors that you're bullish on, and how are you selecting stocks at this point in time?
So I think we clearly have been of the view and that large caps are better placed than small and mid caps, and we have been of that view for last, I would say, 18 months now. So our portfolio clearly has a significant large cap tilt. I think the sectors which look decent to me are large banks. I would say even NBFCs on a selective basis, insurance companies, the even software has corrected quite a bit, tobacco, capex, telecom. By and large, I think that we see reasonable value in Nifty. Now, please remember that Nifty is trading 17 and a half times 1 year forward. The gap between bond yields and earnings yields is now quite reasonable. And for the first time in many years, we can now argue that over time, whenever normalcy returns, there is room for multiples to move up. As far as small mid caps are concerned, I think there is extremely selective value after the significant fall. Once 1 out of 20 stocks, we are beginning to see limited value, but one has to be extremely, extremely selective and disciplined about this. Yes.
Prashant, I wonder what the take with regard to IT is. You suggested that valuations have compressed. Is IT one of those which you're really looking out for in terms of a buying opportunity given this dip?
See, I think it is not a very clear picture, to be honest. But just think of it this way: other than the claims made by the AI companies, so far there is no evidence of any slowdown or impact on the IT companies. Chances are, or our view is, that fiscal 27 is likely to be better than fiscal 26. See, AI will lead to deflation. It will lead to productivity gains. I don't think anyone contests that. The key issue, however, is how does enterprise IT spending on services behave? Will their IT adoption of AI by the enterprises, will it lead to some acceleration in IT spends, or will it at least compensate for the deflationary impact of AI? I think that is the key issue. Our view is that at current valuations, these are reasonably valued sectors, and especially for a benchmark sensitive investor, we would not like to remain underweight that space.
Prashant, since you are sort of recommending that, play it safe in this market, deploy slowly, and stick with the large caps, I want to talk about, banks and financials, given their maximum weightage on the indexes. What one has seen from the quarterly updates and across the board pretty much is, large private, small private, PSU banks, even NBFCs for that matter, that loan growth is looking very strong right now. But how much of this, Prashant, would you say is real momentum? And how much of that could be perhaps just year-end window dressing? And basis that, how do you invest and deploy money within banks right now?
Economy has been doing quite well. As we went into this war, look at all the economic indicators, the demand conditions, the demand for cement, the demand for automobiles, it was quite strong. So I don't think this is window dressing. And credit growth has been improving for a while now. In fact, one can argue that because of the current war situation, working capital demands may actually go up by the sectors that are impacted. Even the OMCs would have significant working capital needs. So I think I would be, unless this impact sustains for a time, when it may start impacting the economy materially. Until such time, I would continue to be optimistic on the economy that we can handle it. And clearly, that means on the lending space as well.
And where within banks are you finding that investable opportunity, or is it across the board?
Sure, our or my clear preference has been for the large banks that have great brands, good customer footprint, good geographical footprint, good tech stack. Basically, I would prefer the larger banks, the larger lenders, or the small and mid-sized lenders. There can be some exceptional companies which execute extremely well. But as a category, I think clearly I would favor the larger ones.
Prashant, if you look at the flows closely, last week was perhaps the week when the FI's net outflows, exceeded the net inflows of DIs. How are you seeing the DIs or the domestic flows coming in? Are you seeing investors putting in more money, or they're taking a pause at this point in time and doing a wait and watch before they put in more money?
I think you must be referring to the net buying and not net flows, because FI selling has been far, far more than the net flows. But let us not forget that the domestic mutual funds, insurance companies are fairly large, and even a 2-3% cash allocation to equities can be very significant. I would expect the flows in domestic mutual funds, insurance companies to hold. And that is because over last 30-35 years, a lot of work has been done by all the stakeholders, the regulators, the mutual funds, insurance companies, distributors, media, IFAs, RMs, everyone put together to educate the customers. And I think these flows are extremely granular, and I would expect these flows to hold certainly. And whenever there is some sign of stability, even those on the fence should come back in. So I feel there is a reasonable chance the flows may actually move up as investors move in to take advantage of the current low valuations. Let us not forget the post the or I mean due to the concessional rate of taxation on equity capital gains, the hurdle rate for and the full taxation on fixed income, the hurdle rate for equities to do better than fixed income is a very low one. I mean, 4.5, 5% is all equities need to deliver to do better than fixed income. Of that, 1% or thereabouts can come from dividend itself. So I think there is a very strong case that over time, equities will do much better than fixed income. I think most investors realize that. So I would expect that these flows to not just hold, but to continue to grow over time.
Prashant, because we're talking returns, you've always suggested that maybe a 10 to 12% return in equities is something which one can reasonably expect. You seem a little more positive now than what you did maybe in Diwali when we had our last conversation. Talk to us about whether now you're penciling in maybe a few more percentage points in terms of returns, maybe over the next 2 to 3 years, if I were to stretch that timeline.
I would think that returns should be better than at 11 odd percent, 12%, what one has been indicating for a while, because then there was no room for multiples to expand. As I said some time back, that for the first time in many years, now we can make a case that multiples in India can move higher from the current levels. And so I would expect that, whenever this thing normalizes, a 10-15% re-rating is possible. And over and above that, an 11-12% longer term compounding in due to earnings growth is certainly on the cards.
And Prashant, you're bullish banks. You're bullish to a certain extent. I found there was a tilt of apprehension with regard to IT, but you were still reasonably okay holding them, at least at this point. Any other sectors, pockets that you're actually liking in a market like this?
See, I think, to be honest, in this market, I mean, you should be positive India, you should be positive Nifty, you should be positive Sensex, be positive the diversified large caps, I think. I think the most of the excesses or excessively valued sectors have corrected considerably, whether it was the consumer stocks, the retail stocks, the capital goods stocks. I mean, everything, the IT stocks, everything is down considerably. So I don't think there is meaningful overvaluation in any of the large cap sectors, and therefore I am generally positive on the market, generally constructive. See, at times like these, you everyone wants to know what will happen next. That no one knows. It depends on what course this war takes, and I don't think anyone can have a definitive view on that. So at times like these, it is best to do a scenario analysis and to get your asset allocation right. If this war extends, if it intensifies, if oil goes to 150, can markets drop 10-15%? Yes, they can. Certainly they can. But what happens after 1 year, 2 years, 3 years, 5 years? That is the key to ask at times like these. See, the best valuations are available in times of adversity or uncertainty. But at times like these, there is also fear. So good valuations and fear of losing more money in the short term will always go hand in hand. So this is the time to get your asset allocation right, to say, yes, the markets may drop 10-15% in the near term, but over 3 years, 5 years, this is a very good investment opportunity for me. Such opportunities come once in 5-7 years. So we should not lose sight of that. And to mitigate the impact of uncertainty, I think it would still be advisable to invest over next few weeks, because when this is just a guess, I don't think this pace of the war, this intensity of the war can continue for a very long time. Yes.
Indeed. So, Prashant, if someone were to say that I'm ready to deploy cash and my horizon is next 3 to 5 years, and I'm ready to take that 15-20% hit even from these levels, should there be the case? In a 100% equity exposure portfolio, what would be the sectoral pie chart looking like? How much percentage to which sectors, given that you won't talk stocks?
I think, to be honest, in these markets, there are very few deeply undervalued sectors. There's hardly anything. And there are no significantly overvalued sectors as well. The dispersion in valuations in India has really come off. So I would say one should simply create a diversified portfolio of large cap stocks. You can, if nothing else, you can simply buy the index, because index itself should deliver decent returns. Having said that, I think large banks do look a bit better than the rest of the markets.
And within the broader markets, Prashant, I know you have a preference for large caps, but do you see small and mid cap coming back as well?
I think it would take time as a category. I mean, 1 in 10, 1 in 20 companies may do well. See, small mid caps, I think, have been misunderstood by many. Small mid caps fell 70-80%, 60% in the COVID fall. And therefore, because of that extremely low base compared to large caps, the returns from that point were much higher. And 3 out of 4 investors in India today have joined the markets after COVID. So they have experienced much higher returns in small mid caps. And that is why I think, to my mind, that is the reason why small mid caps have been extremely popular. But I don't think these higher returns of small mid caps or higher multiples of small mid caps can be justified with superior profit growth. I don't think that is true for the category as a whole. Also, you would agree with me that if you look at the history of capital markets over last 2, 3 decades, whatever has been popular has been an inferior investment, I would say, in almost every single case. So, because simply because whatever is popular is unlikely to be cheap, so I would still continue to be cautious on the small mid cap space, especially, I mean, even whatever low probability you assign, if you assign, I mean, very low probability even then of a markets falling further because of war intensifying, then the small mid caps would be at far higher risk as well. The gap between small mid cap returns and valuations has been bridged partly, not entirely so far.
Prashant, just lastly, you spoke about there being a risk, obviously, as is always the case in equity markets. But talk to us about the risk to or permanent damage to earnings, if at all this war were to prolong from an India standpoint. You know, you have a great way to kind of cut through the clutter and give a perspective on what the eventual outcome could be. You seem to be positive from a 2 to 3 year perspective. What could the risk to that be? Could there be a prolonged earnings down cycle? Could there be a global degrowth that we could start to see a recession of sorts? Is that something at all that could be a risk?
I don't think so.
Okay.
See, even in the Lehman crisis year, India grew 5.5%. What was oil in 2007, 2008? It was $140. There was a time till 10 years back, India used to fund its current account deficit through FII flows. Today, we are in a far better situation. So it is possible that for 1 year, your growth may slow down by 1, 2, 3%. It is possible. But I don't think this will have any meaningful impact on either the India's economy or markets beyond few quarters, maybe a year. Let us also remember this, that last 2 years, India has suffered from extremely low net FDI inflows. Last 2 years, the repatriation of FDI was very high because MNCs were selling stakes, because private equity funds were selling stake. So India's net inbound FDI has been virtually zero. I think that will improve sharply. So while oil import bill may go up, but the pressure on BOP through stake sales by MNCs and PEs will be not there. So I think we will save maybe 20, 30 billion dollars a year of that. So the impact of this oil price hike will be partly or substantially balanced by that. Also, please remember that if oil prices go up, what will happen eventually? Eventually, everything will get passed on to the consumer. Maybe after 3 months, maybe after 6 months. So oil was $20 in 2000. It was $125 7 years later. So was the consumer not paying higher? They were paying higher. So maybe the prices of plastics, packaging, many things will go up. So it is possible for 1 year inflation may move up. But please remember, equities are a hedge against inflation. Till 2000, our returns used to be 15 to 17%. Why? Because inflation used to be 9%. Why? Because currency used to depreciate faster. And India was a supply constrained economy. Today, I think this could lift inflation a bit, but it is a pass through. So if that happens, what is inflation? Companies increase selling prices. So I don't think equity investors, those who have a 3-5 year view, they need to be worried about this. Yes.
Okay, Prashant, thank you so much for your valuable time. You're just the voice that we wanted to hear, bringing out that conviction once again that good news and good prices don't come together. It's only in bad news that you find good prices and good opportunities. So take that plunge is the word coming in from Prashant Jain. Thank you so much for your time.
My pleasure. Thank you. Thank you. Bye.
Okay, let's just revisit where the market has settled in at. Well, it's a no-go. It's not moved.